Sound the alarm. The market is red. It's falling. It's been such a terrible week. Let's just get right into it. Here's my portfolio update for the month of June. And really, it wasn't so much the month that was bad, but this last week was really bad. Down 10% just on the week. Look at the monthly view. We're down much more pedestrian, 4.5%. But it's really been a pretty rough go this really last year in the stock market, especially for my portfolio. I'm going to go ahead and keep zooming out. It's getting more and more painful to look at. Down 11% over the last quarter, down 30% over the last year. All time, not quite as bad, down that's about 12 grand. It's money weighted, so the return metric is a little goofy, and because I've been adding money to this portfolio as we move along. But in general, it's been really rough. The market has not been kind to my existing holdings. However, this is part of the game. And as of Monday of this week, the S&P 500 is officially in a bear market, meaning things aren't so good for stocks right now. Things keep falling. Now, that doesn't mean they can't turn for the better in the near term and start going upwards. And it really depends on your perspective here. If you're looking to buy stocks and you're not looking to sell anytime soon or leverage against those stocks anytime soon, then this really shouldn't be all that bad. But nevertheless, for human psychology reasons, whatever it is that goes on in between the years, this is really hard to stomach sometimes. It's just hard to see your holdings go down, especially after you just invested in them. You're expecting long-term positive returns, yet in the short term, you get hammered with this horrible market that we're going through and that many investors are going through. And there's never really an escape from it. You see headlines like this, the bottom line is it's a tough time. Great, thanks. Didn't really learn much there. All I know is that the market is going down, and now I feel bad about myself. And you see that throughout the financial media, and it's really the opposite as well when the market is in a bull run. You see a lot more overly positive articles talking about how great the economy is, how great the job market is, whatever it is. It's going to be much more positive. Now that the stock market in particular is starting to wane, you're seeing other sort of negative news come out about the real estate market. Things are slowing. You have the Federal Reserve, obviously always a key player, both up and down. They're continuing to hike rates, and there's just a lot of concern in the market, rightfully so to some extent. However, you start to see really a lot of the human emotions at play when you go through a very volatile time like this. Let's go back to my portfolio view, and let's go ahead and take a look at the one-year view again. Let's keep looking. Let's keep looking. It's down $24,000. That's a lot of money. That's quite a bit of money. That was practically all of the money I made during my second and third years of law school when I was working part-time, put in a bunch of hours to make extra money, and there it is, currently vaporized. Though it could rematerialize soon, but just trying to put this in perspective and take a look at these losses. They're paper losses for now, at least most of them, but just trying to come to terms with this and realize that this is what happens in the stock market. Sometimes you're going to get huge runs down, even when you think you have great picks, great undervalued picks that shouldn't go any further down. Well, they will surprise you again and again and keep going down. Look no further than Alibaba. But I do think it's weird that when you're staring down a loss of $24,000, it seems to trigger a much greater emotional response than looking at a gain of $24,000. And that's not to say that the gain is not somewhat exciting, but for some reason, when the stock market is down, even though I'm technically a buyer of stocks, I have not been selling stocks really at all over the last few years. I'm continuously adding money into my portfolio and continuously trying to buy stocks. So I'm a net buyer of stocks. So I shouldn't really mind the stock market going down nearly as much as I would mind it going up because I'm trying to buy these stocks at a discount. But for some reason, human psychology, maybe it's because of our aversion to losing what we have. It's a sort of protection-oriented disposition that humans have. I don't like seeing what I have being lost, at least not as much as I would like to see more things being added to my portfolio. It's this weird sort of psychological tilt. And the thing is, there's still a ton of room to fall for pretty much any of my holdings. For the broader market, for individual holdings, we'll go into the value slice to see where a lot of the damage has been done. This is the largest section of my portfolio, and pretty much no holding has been spared, although CVS still remains positive on the year. We'll go back to the monthly view just to keep it in line with this update. Equity Commonwealth, which is basically just a pile of cash and a few office properties, that's up a little bit, but it's been pretty stagnant over the last year or two. And then you have Turtle Beach down big. Smith & Wesson has been, they're sort of, I don't want to call them counter-cyclical, but they've held up, but they're not up huge, and that's really after falling quite a bit in the last year, but I added during a lot of that dip. Anyways, Foot Locker down, Sleep Number down big, especially recently, Dropbox down a little bit, CVS down over the last month. So it's been brutal for all of my holdings. And we go ahead and zoom back out to my commodities slice. Even commodities haven't done well. Pretty flat on the month, down generally. But if we go to the 1 week view, it's been really bad. A lot of these things are down double digits. So it's been pretty brutal, pretty much no matter where you are. Even cash is not that great when you compare it to the inflation rate. Pretty much everything is a losing bet right now, except for if you were shorting things, then you're making money as things go down. When you're in cash, you have your purchasing power being eroded by inflation. When you're invested, you're having it being decimated by the falling demand in the market. But like I said, that doesn't mean that things aren't going to turn around tomorrow. That could always happen. The market, especially in the short term, is a very fickle beast. But just because we like pain, let's keep going down the line, taking a look at big tech. This has Alibaba and Facebook, now Meta. And Alibaba actually had a big surge recently. So it is up on the month, but it has fallen again recently. I think it's back close to 100 again. Yeah, got up to, I think, about 115. So it's been bouncing around very violently, as it really has been for quite some time. And Facebook has fallen down well below $170. So I'm very interested in adding here. I added a bit recently. My cost basis is all messed up because it changed the ticker symbol. So it used to be FB, now it's Meta. So I'm not sure what my exact cost basis is, but I think it was closer to about 200, towards the kind of 190 mark, I think is where it was. So it's somewhere around there, technically speaking. But this is definitely a stock that's high on my list to add to in the near future. And if we go back, let's keep going through the pain. If we go back all the way to the main portfolio, even Berkshire, good old Berkshire Hathaway is down. Obviously, a huge portion of their portfolio is Apple, but a huge portion is cash and a lot of cash flow heavy businesses. Yet even they have not been spared, down pretty significantly over the last month, down over 1% today. And then last, but certainly not least, we have the covered call ETF, which has been pretty flat, and that's kind of by design. If the market is sideways, it should do better than if you were just in the S&P 500 because it's developing income through covered calls on the S&P 500. So it's developing income that whole time, producing income by selling those contracts. The risk of that is that it technically caps your upside because you are selling the covered call, or at least the fund is selling covered calls on the S&P 500. So if the S&P goes past that covered call strike price, then you are missing out on those extra gains that you would have if you're just invested in the index straight up. However, on the flip side, when the market goes down, you're still developing that income. You're still producing that income as the market goes down too. So it limits your downside a bit, but you still are exposed ultimately to a lot of S&P 500 equity risk. Either way, it's not a particularly huge holding for me, but hey, it's down nonetheless. So that was the tour of pain. And that was really just looking at the monthly view, which definitely looks a lot better than the weekly view. Like I was saying, everything is down pretty significantly. And the yearly view, things are very down. Keeping in mind that a lot of the money that I've added to this portfolio has been in the last 6 months or so. So a lot has been added pretty recently, which is when the market has done particularly poorly, at least compared to the last couple of years. And like I said earlier, there's still plenty of room to fall for pretty much any stocks. They can always keep going down, especially an individual holding. It could go all the way to zero. You never know what's really going to happen. You're taking risk when you buy into the stock market. You're buying shares of companies. If the companies don't do well, the stock probably won't do all that well either. Although you can have some sort of decoupling between business performance and stock performance for a variety of reasons. But over the long run, fundamentals tend to reign supreme. And right now we're really looking at short-term moves. It's been a few months of really bad stock performance, but I certainly don't view that as long-term, just a few months here and there. It's really about investing for 5, 10 years, which takes a really long time to figure out whether you've actually made a good decision, but that's how I'm trying to invest. I'm not planning on selling anytime soon, and if I want to pull liquidity from this portfolio, I can go up here to borrow, and I can borrow against this portfolio. Granted, if the portfolio goes down too much in value, you're at risk of a margin call if you have margin debt outstanding, but I wouldn't try to be that crazy with it. But regardless, I can still pull some liquidity out of this portfolio if I want it without actually having to sell, which is a big perk of why I like using M1 Finance, because with M1 Plus, it's only 2.75% interest. That's a variable rate. Of course, it could change. So as the Fed keeps hiking up rates, that will continue to go up. And to that, I'm probably going to need some liquidity pretty soon. Maybe it's going to come from margin. Maybe it'll come from my home equity line of credit, my HELOC that I currently have that's at a similar rate. I think it's at 3% right now, also variable rate. Regardless, I like having this option here because if I want to buy a piece of real estate, which I'm planning to do pretty soon, I have that option there. However, there is something to be said about carrying a larger cash balance because I currently don't have a ton of cash available to go and invest in some of these depressed holdings that I might like to invest in. But I'm trying to remain pretty much fully invested, maybe keeping some cash on the side. I always have cash for my rental properties. I always have cash reserves there, but I don't really count it for net worth purposes. It's not like it's liquid cash that I'm going to be using to invest. Otherwise, it's keeping that off to the side. But as for investable cash, that's pretty much going out as fast as it's coming in that as soon as I get paid and I have that extra cash left over, I'm trying to invest it into something. Maybe it's going towards a rental property sort of savings fund. Maybe it's going towards stocks. Maybe it's going towards something else. But the point is I'm trying to put it to work pretty much immediately. And so far, that really hasn't been too hard for me because I feel like there are some good deals in here that, at least for my personal risk tolerance, I'm not saying you should invest in any of my holdings. I might be a terrible investor. Time will tell. But I'm trying to invest in things that I think are a good deal for my own preferences. You might have a very different risk tolerance than my own. You might have different assumptions with given individual stocks or even the broader market. You can do your own strategy and you should do your own strategy once you do your own research. But I appreciate all of you who've been along for the ride. I swear I thought I was a couple months away from reaching $100,000, which is kind of the whole initial goal of this series. It's to build a $100,000 portfolio, yet it just keeps teasing me, gets up into maybe the low to mid 90s. It was there just a few days ago. If we actually go back to the 1 week view, yeah, it was over $90,000, almost $91,000 just a week ago. Now it's all the way back down to about $82,000. It's just a little bit frustrating because I want to reach that arbitrary $100,000 mark just to say I got there, but nope, the series must go on. And not that I would end the series after reaching $100,000, but at least this first chapter of it would be ended. So thank you all for sticking around and for your consistent support. Definitely check out M1 Finance with my affiliate link in the description below. It's a free to use brokerage, so you can check it out. It's free to open an account, so you might as well take a look at it and see if it suits your fancy. But otherwise, like, comment, subscribe, all that great stuff. And until next time, take care.